All six of Canada's major banks have released their quarterly earnings this week, and all six outperformed. The sector posted strong profit growth and record revenue fueled by wider interest margins, higher fee income, and solid trading results. To help us break down what's behind the numbers, we're joined by Steve Rowles, Senior Portfolio Manager at TriVest Wealth Counsel. Steve, thanks as always for joining us.
Great to be here, Roger.
Good, solid numbers, but they're the banks. Are people going to be happy with what they're seeing?
They're the banks. Yeah, I think people will be happy with what they're seeing. I think CEOs are going to be happy with what they're seeing. Broad-based beat across the board, double digits. But most importantly, I describe it as diversified revenue streams, really paying off in all categories, in all segments. Very positive day for the banks. 6 for 6. Can't ask for much more.
And that diversified, that's important. What are they doing right? What are the individual banks doing right? Is there certain areas one is outperforming the other?
Well, I'd say that one thing that they're doing quite well on is benefiting from the market altogether. The wealth management it was an incredible component of their profits last quarter. We saw Royal Bank increase of 32% on the wealth management side. Capital markets also benefiting. But what's really helped out across the board is the benefit of having a proper yield curve, and the net interest margins were quite healthy across the board as well. So it's right place, right time in the right markets, and things worked out quite well.
And with the wealth management, any concerns? I mean, what goes up can go down?
What goes up can go down, but it is quite sticky money with the private wealth side of the business. Fees are what they are, and it has been quite positive. So I think that as long as the market continues to do well, as we're seeing in Canada and diversified portfolios, that we expect to see continued growth on the wealth side.
And losses, I saw a couple of banks actually were lower than expected, and overall they didn't seem that bad.
Yeah, we're seeing that in Royal Bank. It's actually down a little bit. I think was close to 2% down, and it is the bank. It is the biggest. It is the one that makes the most money, and there is some profit taking there. I believe it looks like from a valuation point of view that it is the highest value from the valuation metrics. There are concerns about that perhaps how much more growth can really happen in the market from a value point. Like I would describe most of these banks as being fairly valued. They've had a great year, but how much more room is there to go? That is a question out there.
Yeah, I think that is the big question. So what can we expect moving into 2026? What might be some headwinds or concerns?
Yeah, I think at this stage, you do have to look at some potential headwinds. One thing about the Canadian earnings compared to the U.S. is that we don't have as much guidance in Canada. I sort of call it three-down football. We don't really analyze Canadian banks the way we do look at JP Morgan, which we know what their net interest margin is going to be. It's $105 billion. Are they going to make it? Are they not? We don't decipher the earnings reports like we do in the States. We're more focused more on qualitative, how are we going to get to the ROEs, that type of thing. But I think the one thing that stuck out is that there's some tepid loan growth. RBC only had about 4% loan growth. So with our economy going through some changes, we're going to get GDP tomorrow, but we'll have to sort of see how resilient we're going to be as a consumer. It's been a year of uncertainty, and we've been resilient, but we really need to focus on the overall economy, and that's something that the banks need to look at as well.
And with the Bank of Canada, I mean, it looks like we're standing pat. We actually, I don't think I've talked about the Bank of Canada for nearly 5 days. What kind of an impact, if it stands pat with its rate, what kind of an impact might that have on the banks?
Yeah, good point. I think there is some room for Bank of Canada to make a move, follow the U.S. If the U.S. cuts, I think Canada will cut in line, which will further enhance the net interest margins with more of a steeper yield curve. That always benefits banks.
But we're not really expecting that, though. I mean, the talk was we might even see a rate increase. What would that do?
I think with inflation, I think that if anything, it's going to be a pause. But I think that I look at the market as more potential of having rate cuts than rate increases. I think with the wave of mortgage refinancing coming on board here over the next couple of months and over the next year and a half, I think that Canada's and their consumers not strong enough to withstand higher interest rates. And our dollar is holding up. So I think it's a case where our economy needs a boost, and any way it can get it. And I think that the lower interest rates would benefit the economy dramatically.
And international, going outside of Canada with the banks, any growth plans there for them? What direction are they heading?
Yeah, we're seeing that, of course, with Bank of Montreal sort of leading that way. Is that if you go down to LA, for instance, you're going to see a lot of advertising for Bank of Montreal. It's quite impressive, and the growth in the U.S. for Bank of Montreal, TD, Royal is extensive, and it's showing a lot of resilience. So with the U.S. and their fiscal policies and their expansion has really impacted that diversity as well. So it's a win-win for a lot of the banks in the U.S. right now.
Okay, Steve, we'll wrap it up there, but thanks as always for joining us.
Great. Thank you, Roger. Have a good day.
You too. Steve Rowles is Senior Portfolio Manager at TriVest Wealth Counsel.